Good afternoon this Tuesday, November 26th. First, the staff and I would like to wish you and your family a safe and happy Thanksgiving and many things to be grateful for this year. You could be living in war-torn Ukraine, Russia. You could be living in Israel or Iran. You could be living in the places that were hit heavily with the hurricanes here in Florida. Sometimes we want to always think monetarily. You need to think of your health and need to think of just how safe we are in this country to give thanks for that. So for that, we extend our gratitude. Well, today, the Trump traders gave it a run as President Trump yesterday afternoon announced that when he becomes president on January 20th, he said he's going to put a 10% tariff on China immediately and 25% tariffs on Mexico and Canada because of the fentanyl crisis. Now, here's where the market doesn't see this correctly. They're acting like he's president today. Let me remind you that this presidency probably is going to have the longest serving time ever because he's not even taking office for 56 days and the world is reacting to his policies now, which is a good thing. And if you read The Art of the Deal, this is part of his game. He's already put Canada and Mexico on notice, which means he's already working on them for 56 days until he becomes office. There are no tariffs put in on corn today, yet corn was down on the threat that Mexico may be buying less corn. All we did was put it on sale for them today so they can buy even more corn ahead of January 20th. Soybeans tried to break, but soybean oil was able to rocket higher today off of the recent break, as putting 10% tariffs on China means the end of used cooking oil coming in from China, which is mostly palm oil, that it won't be profitable. So that supports our own biodiesel industry. So kind of a win there. And the trade is so overwhelmed with trading the Trump trade and the good weather in South America, they really couldn't break it. You'll see that as I go into these charts. So I'm going to leave you with this point before we go on to the charts, is that President Trump, when he takes the presidency on January 20th, the heavy lifting was done in his first administration. Biden didn't do anything to remove the tariffs, so they're already in place. It doesn't take much more for him to push and get a reaction, as they've already been fearing him for 56 days. And all they got to do in Mexico is clean up the illegal immigration by putting the military back in place like they had when Trump was president and reduce the fentanyl. Same thing goes with Canada and Mexico and China. You do that, the tariffs won't even go on. And so we're selling rumors where the fact could likely get bought. So let's take a look at some charts. Well, first we're going to start with the beans and notice that beans for January and the other contracts, they are all in a fourth wave down. And what's even more bearish, which isn't occurring, is they're creating what we call a flat bottom descending triangle. Now, historically, what happens is that, yes, it could come up and bounce one more time and then drop. But history says they will go out the bottom. But they're having a hard time doing it. They tried to do it late last week. We had an early week rally, 2 days up, and today's break. They just couldn't pull it off. Of course, Mr. Soybean Oil stopped that, as that wreck that soybean oil went through for 2 weeks hit trendline support yesterday. And we had that news in the newsletter yesterday. And of course, we've seen a bounce. Now, since bean oil is in a berry structure, it might bounce to the purple line and still break lower. And that's when beans take their setback. But we'll see. March beans, they had broken a little bit lower than prior support. And when you look at this, they're just kind of hanging on the shelf. They need to get going. Resistance on Jan beans for the blue line is $10.02. For the March contract, it's at $10.10 or 1009.7. The point is, they've got to lift this thing through another 17, 18 cents and do more than this break. Now, this false breakout, when you look at the blue line, it's been quite amazing, especially once it crosses, it holds for a while. This was a real bugger of the way she popped for 2 days and came right back down. So going through again probably will have more staying power than this fool me once, shame on me, fool me twice, shame on you event. They'll probably try to push higher for whatever this is, and maybe this is China winning the trade negotiations without even firing a shot, so to speak, with tariffs. Now, corn broke on the Mexican story, fell through our favored moving average here, the 64-period moving average. The 50-day moving average would have been just under it. Nonetheless, it's the 100-day that the corn fell to and held. And if we could turn up here going into the holidays, we'd still have a series of a 1-2, then a 1-2. Both breaks are ABC in nature. This one is more prominent, ABC. And we're going to start wave 3 somehow, some way. I don't know. Maybe it's Ukraine, Russia. Maybe Ukraine uses one of our longer range missiles and takes out the Kerch Bridge, where a third of all the grain flows through from exiting from Russia. Or possibly Russia doing something with one of the Ukrainian ports. Don't know, but things seem to be picking up there while Hezbollah and Israel are dialing it down. Possible truce there. And of course, weaker oil today weighed on corn as well. But we'll see here, the 100-day moving average. Let's blow it up here so you can see how important it is. Here's the 100-day going back in time. It stands in at critical times. Market went above it, tried to stay bullish for a while, couldn't hold. But here's a 100-day lined up with our 64 as well. So we'll see. I'm friendly corn. I do believe this was a major low. This is not just a little ABC rally before we drop it out of bed. I do believe corn will rally as it seasonally does into January, February, when we'll probably have China buying us some corn from us, against their will, whatever it might be. But China will probably show up for some corn. And our carryout, by the way, it's going down. And by the January crop report, I think you're going to see our carryout under 1.9 billion, on its way to 1.8 billion. Continuation chart, March came on this here blow up through the gap. That was March coming on. December stalled at this line. Well, March came on, fell through it. That's what makes 430 so important. You need to get back above 430 tomorrow. Keep corn looking in a good way heading into the weekend. And then we can just say it's just trending higher with volatility. Now wheat, overnight wheat was up 9-10 cents as it was announced that farm stocks for Russian wheat were lowered. We're down 20% year over year. They will not be exporting 5 million metric tons per month going forward. The southern region only has 6.3 million metric tons stocks on hand, lowest since 2020. Russia's going to be falling away after the first of the year. And whether Ukraine wants to pick that up, which they don't have that much to, or it's going to have to all be Argentina and Australia. Probably not likely. U.S. is going to get some action, and that will firm our prices up into January, and we'll see how the crop production goes, maybe even into the opening of April. So today, a pullback to yesterday's low, holding the 786 retracement levels. We need to get moving average resistance here up at that 576 range. Get through that. Things will change. Get through that. Kansas City wheat, just look at the trend line. Here too, just get it through 580. Things will change. Continuation chart, Kansas City, March came on this day, stayed under the green line, get above 568 to 570. More importantly, this week's high at 76. Things will change, and we'll start seeing a larger rally take place. Now we get to cattle. Isn't it interesting? February cattle, all the news. Yesterday's screw worm event. Box beef jumping well over $4 today, choice and select. Now possible 25% tariffs on these Mexican cattle coming in after January 20th. Of course, that's way out there. What do? We stay under this trend line. Look at how we close here. We stay underneath. This is amazing. We do know that live cattle did pop higher yesterday on the excitement, installed at our 190 rally resistance point that the continuation continues to throw at this market. Someday, are we going to have $200 cattle? Well, it's going to have to be February or April. I do know cattle. Sometimes they stay sour until Pearl Harbor Day, but once you get from December 7th to the first of the year, cattle get strong. And so if it occurs, maybe it's going to occur after December 7th, where we go through 190 and start making that trek to the 199 range. Feeder cattle, back up to yesterday's high on, of course, the tariff scare, but there's rumors that these feeder cattle will start coming again back into the United States, 100,000 a head a month by the end of the year. And of course, the tariffs, well, that's January 20th. So feeder cattle could be seeing a spike high short term, not that they can't continue higher. Continuation chart. Also, you can see all this resistance up here, 265. So clustering, probably get a minor correction in here, and then still push higher into the new year, targeting probably 265 or higher, because if there's any heifer retention going on as we enter next year, well, we just know the feeder supply is going to be that much tighter. Hogs, well, 1, 2, long 3, wave 4 is completed. We showed you this last week. Wave 5 is on its way. We're doing it. We think the summer hogs, we're going to get a chance to hedge some of those June and July hogs in that 105 to 115 range. Let's go to crude oil. Well, the apexing is getting tighter at the bottom side. Note, we had these spins back and forth. We implied we could go to the upper channel, but the shorter term moving average, our 77 period exponential moving average, cut us off at the past November 4th. And again this week with the possible ceasefire, but the true downtrend breakout needs to happen with closes below about the 66.5 range. Then she gets negative, and we go back to our long-term range where we had this top. We projected a 1, 2, and a 3, but the 3 got circumvented with this apex. But once we start breaking down, we will be working a wave 3 to the downside that could take us all the way down later into next year, possibly challenging the low 50 range, 53, 54, 55. So we are in no hurry forward pricing any fuel going into the end of the year. Last year we did price right at the end of the year. We priced our spring planting and spraying needs. And of course your high came, burnt off in June, has been moving lower since. And so that's why we haven't talked about fuel prices. We will probably be holding back for now. Drill, baby, drill, right? That's what the scenario is. Again, happy Thanksgiving from the staff of HeartlandInvest.com, Heartland Investor Capital Management, from myself, Eugene Grainer, and everyone else. Have a good Thanksgiving.